What's up, guys? I'm Mike from Stocked Up. In this video, I'm going to be going over pretty much what's going on in the market right now and what I'm going to be doing for next week to profit. So I'm looking at the SPY right now. Literally, we're in a market right now where the SPY was flat throughout like the first hour of trading on Friday, and then Trump tweeted and sent the market down over 600 points. So pretty much the market is extremely volatile right now, and any bad news, especially trade news, whether it be with China or the European Union or any other country, it's going to hurt the market. So we could look at futures right now. So if we look at Dow futures, they're down 328 points right now. And I mean, look, we still have 15 hours before market opens, but they opened down 300 points. So who knows how bad it's going to be come real market open when the real volume comes in. So pretty much what I'm doing, what I'm looking at is value stocks. Value stocks are pretty much stocks that people resort to that, they hold their value, they're good, strong companies, and, a lot of hedge funds and institutions buy into them because, they're strong companies and they tend to hold their value in times of, fear. So we're going to look at a couple of value stocks. So like McDonald's, you can just see it's like a nice solid uptrend. Starbucks, nice solid uptrend. Coca-Cola, nice solid uptrend. Home Depot, you get the point. They're stable. Even when the market's bad, they at least hold their value better than other stocks. So Home Depot, Starbucks, McDonald's, Procter & Gamble, Johnson & Johnson. So these are companies that have low implied volatility. So when the market does bad, yes, these stocks are going to fall, but they fall less than other stocks. So I'm going to be looking at these stocks because if you see value stocks falling bad this week, something's definitely wrong with the markets, and wrong in like a bad way. So pretty much like you expect stocks like Tesla, high implied volatility stocks, to be crazy. They're growth companies and they're risky overall. Like you could see Tesla, it shoots up one day and then just completely reverses and then falls back down the next day. So like it went from $300 to $320 in 2 days, and then went from $320 to $270 in 3 days. It's a volatile stock, but that's expected, right? The implied volatility is high. You have to deal with it. But with stocks like Johnson & Johnson, Procter & Gamble, Starbucks, Home Depot, these are stocks that are expected to hold their value. Like you could see, they're not as crazy as Tesla. They're just calmer. So their IV is lower. So the thing is that if value stocks are falling on Monday, think about who invests in value stocks. Johnson & Johnson, 70% of Johnson & Johnson stock is owned by institutions. That is insane. So if Johnson & Johnson's falling, guess who that affects? That affects like people's retirement accounts. Like people have hundreds of thousands of dollars in these value stocks. You don't see that with Tesla and other growth companies, but you do see people putting large amounts of money into stocks like McDonald's and Coca-Cola. Like these are people's retirement funds. So if these are falling, like let's say you have someone who has like $100,000 in Johnson & Johnson, and let's say Johnson & Johnson falls 5% in a couple days. That's $5,000 some regular person just lost. That's their retirement fund. So like that person might be like, all right, something's up. Maybe Johnson & Johnson stocks just, having a bad week, right? And then a week later, it falls another 3%. And then they lost $8,000 overall. And then let's say it falls another 3% and they lost $11,000. And then they sell, right? All the sellers, like when people who hold these stocks, when they sell, it's just going to keep bringing the price lower and lower and lower, all right? Because supply outweighs demand, so the price falls. So now Johnson & Johnson stock is overall down about 11%, and you still have all these sellers coming in. So now Johnson & Johnson falls another 3%, and then overall it's down 14%, and then even more sellers come in. So what I'm trying to get at with this story is that when people start dumping these stocks, it's going to affect people's retirement accounts, and it's only going to get worse. So if you see a stock like Coca-Cola or McDonald's fall 7% throughout the course of a couple weeks. It's only going to get worse, right? I wouldn't look to buy the dip there because more people are just going to keep on selling and selling and selling in case like the stock keeps falling. People just want to, cut their losses. So if value stocks fall within like the next 2 or 3 weeks, especially this week, that's going to indicate something bad, one, for the stock overall, like Johnson & Johnson, but two, for the economy. You know what I mean? Like, think about who holds these stocks. 70% of Johnson & Johnson is owned by institutions. So think about when these stocks fall, think about who that affects. So it's only going to get worse, not only for the stock, but also for the economy. So I'm looking at one specific value stock that I called out in stat modeling on Friday. I'm looking for that one to fall. Bottom line, though, is you're going to always see stocks like Tesla, like high implied volatility stocks, and Boeing fall and just be volatile, but that's expected. So when you see a stock like Tesla pop 5% or fall 8%, is it crazy? Yes, but that's also what they're meant to do. Like, they're volatile in nature. But you're not supposed to see stocks like McDonald's or Starbucks or Coke fall 4 or 5%. That's not what they're made to do. And just looking at McDonald's, it's not looking good for the next couple weeks. So implied volatility is rising. Just look at this chart. Like, if value stocks fall, their put options are going to explode more than any other stocks put options, and that's because it's not expected. Like, you could see with the options market and options pricing, it's all about what's expected. Like on Nordstrom, JWN, the stock popped about, like 8 or 10% on earnings, but the call options that I had only popped about 100 to like 150%, and that's because they were expected to have a big move. So, the calls went up, but the stock went up 10%. You would think that the calls would go up like 800% or 2200%, but it's all about what's expected. So all these big value stocks like Johnson & Johnson, Procter & Gamble, they aren't expecting big moves. So if there is a big move, these put options are going to go up more than anyone else's. So like if we look, and you always want to make sure you have time too. It's always better to buy more time than not. So like let's say you go to October put options for Procter & Gamble, and then you pick up a 100 strike put option. Right now, they're only going for $49, which is pretty cheap. But look, you have all the way till October. Now, yes, it's far out of the money, but if Johnson & Johnson even falls to like 110 this week or next week, it's gonna, this option will go from like $50 to $220. You get my point. But the bottom line is that growth stocks are expected to be crazy, like Tesla, and value stocks are not expected to be crazy. They're expected to hold their value. So if they don't hold their value, then their put options are going to go up more than any other stock's put options. All right. I hope you learned something in this video. If you have any questions, let me know in the comments down below. But other than that, thanks for watching.